Hello and welcome to Looking at the Markets with David Modell. So much going on. Sky high inflation that's not transitory. Sorry, guys and gals, it's just not. This could be great for certain stocks. We're going to think about some stock picks today. Maybe gold, silver, commodities, boom, that's just getting started, and real estate. We're going to cover a lot of things with Mr. Lior Gantz from Wealth Research Group. Let's get into it. Mr. Gantz, welcome to Looking at the Markets, sir.
Hey, thanks for having me back.
Yeah, I appreciate it. So, boy, the Fed really did it this time, didn't they? First, a 50 basis point interest rate hike last month, and now a 75 basis point rate hike. This is not what the market wants. What is this going to do to the markets as we head into a cruel summer, I think?
Yeah. So not last month, but on the 15th of March, the Fed raised interest rates by 50 basis points. And then just this past June, they did another 75 basis points. And they're going to do another 75 on the 26th of July if nothing changes. So we're going to go into an environment that's above neutral, right? We're going to go, if they raise by 75 basis points, we're going to go over the 2%. Which the Fed defines as somewhat restrictive monetary policy. At the same time, they're selling assets from their balance sheet, and the whole thesis is that the Fed does this in order to balance out supply and demand in the real economy. What happens when the Fed raises rates is the cost of credit is elevated. Therefore, there are more options for fixed income and there are less options for growth. And when you create that, you're trying to balance things out, because for 13 years, the world has operated under zero interest rates, and that has led to a focus just on growth. What we call TINA, or there is no alternative, right? If you can borrow money as a corporation for zero, and if you're a government and you can borrow for zero, the stimulative measures in the economy artificially for 13 years compounded on themselves. And what happened is with COVID-19 and with the loss of income for that first quarter of 2020, when they stimulated it back, because of the restricted measures that all of the global economy operated under, there was a focus on goods and not on services. People can order from home when everyone is cooked up, a lot of appliances, clothing, and whatnot, goods, products, and not services as America normally does, goods and services being out and about, etc. That created a whole problem, a whole slew of problems for supply chains, logistics worldwide, with warehousing and with shipping and with ports. And this whole thing, in the eyes of the Fed, was a transitory thing. And it is true to an extent. But some things, when you do them long enough, even if they're transitory, they become habitual. That's what happened. Basically, the whole scenario that we're going through is because something that was not habitual became habitual. Supply chain constraints became an habitual thing in our economy. Favoring goods over services disproportionately has become habitual in our economy. We're just going back to this new normal, but even that is not the same as before. Preferences have changed, behavior has changed. And so the Fed, what it wanted to do in 2021 is just look at things before they make judgments. The Fed is such a big institution that it cannot operate like you and I can, where we can make small changes and to our behavior or to our strategies and tweak things. The Fed does overarching, large, huge decisions that impact everyone around the globe. So they are nearly always behind what's happening. They need to look at it, get a sample study of what's happening, and then adjust to it. Therefore, they are late to many things. And then when they do react, oftentimes it happens in a matter of some sort of aggressiveness that the markets are not accustomed to. And that's what's happening right now. The Fed and the market are trying to decide where equilibrium is, because obviously we have an overheated economy in the United States, and raising interest rates, what it's supposed to do is cool that off. But for the first 6 months of the year, all it did is just destroy equity wealth, because the indices are all in bear markets except for the Dow. And that creates a lessening of the wealth effect, right? If somebody has $1 million saved up for retirement and now he has $800,000, well, it means either he's going to stay employed for an extra year or 2 years or 3 years, or he's going to say no to that vacation he was planning, or not do the upgrade to the pool, or not buy new appliances or change his car or whatever, because the wealth effect, he feels less rich. So that's one thing the Fed has done in the last 6 months. It made the wealth effect go down substantially. Secondly, it deters people from going out and originating mortgages, because the monthly payment has now jumped almost 100% in some areas. So, and 40, 50, 60%, like the changes have been substantial. The problem with real estate is that if you say, okay, well, you're right, this is valid, 12-year high for mortgages, rents are also very expensive compared to 2, 3, 4 years ago. The problem is a shortage in new construction, and not that just home ownership is out of hand. Home ownership is out of hand for many people, and also renting is becoming a problem for many people. So what the Fed is dealing with is that a lot of the problems, so be it housing and other or worker shortages, 11 million job openings but only 6 million applicants, is not the Fed's doing, and it's not under the Fed's control. And we have seen very few creative ideas from the government. And that's the real problem that I think we're facing. That's why the Fed is being so aggressive so quickly in 2022. It's because the government is doing nothing. They've rested all of their hopes on this BBB plan that's out the window, and they're just not moving fast with things that can solve the problems. I'll give you a quick example. There are 2,000 ports in America, but Long Beach and Los Angeles, 2 of the 2,000 handle 40% of the imports coming into this country. So there's going to be a problem there. There is a known problem with 400,000 truckers that are short. We're short 400,000 truckers in the economy. There's also a shortage of 70,000 forklift lifters in the economy. These are problems that the Fed has nothing to do with. The Fed is a bank. It can raise interest rates, lower interest rates. It can sell assets or buy assets, but it has nothing to do with all of these issues that have to do with taxation, regulation, managing municipalities, and dealing with creative incentives that can happen in the economy, or what we call fiscal policies. I think that's what the Fed's dealing with. The markets want higher interest rates. They want the Fed to keep raising rates. The problem is not that. The problem that the markets are discounting is not just higher rates. The market is discounting a global shift in globalization. We have seen peak globalization about 2 years ago, and we are now deglobalizing. just like we did 110 years ago in 1910, when the world deglobalized and we entered a few years later World War One, the Roaring Twenties, the Great Depression, World War Two. Deglobalization is a very destabilizing environment. The free flow of information, of ideas, of capital, the cooperation worldwide is diminishing. People and countries are getting more nationalistic, more focused on themselves. And that creates a whole slew of new challenges. And I think that's what we're seeing. We're seeing the markets discount for this new normal. And this new normal is more expensive to live at, because if I need to source lithium from America or from the United States instead of from the cheapest source that I can get it from, because these other countries are also shutting down supplies, then it's a problem. Because America, for example, has one active lithium mine. I'm just giving you that as an example. We all know that America relies on China for a lot of manufacturing. That's a problem, where you see these ports shutting down in China for weeks and weeks. So we are changing paradigms, and that's a very discounting phenomenon. Now, some of this discounting is overdue, but some of it is way more than expected. There are real opportunities already out there in the equities market, and in some areas there's just been bubbles that have been deflated. So I think in general we are in this very unique reset that we're going through right now.
Yeah. And I want people to visit, I'll put a link in the description underneath this video, wealthresearchgroup.com. They have a newsletter that you need to sign up for. Very informative. That website, and also Lior Gantz himself, has warned everybody about inflation so many times and has made so many great predictions. Speaking of predictions, not to put you on the spot, but gold and silver. Gold stuck in the 1800s. Frustrating for some people. Silver, it should have been at least 25, 30 by now, but it's still in the 21s, 22s. With the dollar deteriorating as it is, why haven't precious metals broken out yet? Do you see this coming soon?
Yeah, great question. And thank you for mentioning the newsletter. I also put together a special report about the bear market and about the recession and everything like that for your viewers. If you want to go to wealthresearchgroup.com/bear/pain, like PAIN, and /rug, like RUG. I think those three reports sum up with a lot of charts and graphs and a lot of good content, the recession fears that we're seeing, the housing bubble fears that we're seeing, and the bear market in equities. And I think people need to really understand what transpired and what's going to happen. With regards to your question, I think that we need to put two things in perspective. One, the dollar is actually not deteriorating. It's at a 22-year high compared to other fiat currencies. We are creating a similar environment as post-dot-com bubble. If you remember, 9/11 happened, and there was a lot of destabilizing, and the dollar was hitting highs compared to other fiat currencies. You can go to the DXY index and look at it right now. It's trading at a 22-year high. So the dollar, on a relative basis compared to other fiat currencies, is very strong. Also keep in mind that when you sell stocks, any stock, or when you sell treasuries, what do you get settled in? What's the transaction measured at? It's measured in dollars, right? When you sell shares of any company in America, you get redeemed in cash dollars. So the demand for dollars accelerates actually in market sell-offs because everyone is demanding cash. So that's another thing that's technically creating a very strong economy for the dollar in 2022. With that, let's look at gold for a second. Gold is trading at 1850 or 1840 as we're doing this interview, and it's up about 1 or 2% for the year, for 2022. Now, if you look at what that means, it means that while The S&P 500 is down 24%. The Nasdaq is down 33%. And the Russell 2000 is down 35%. The Dow is down almost 20%, with individual companies down 80, 90, 50, 60, 70%. And I'm not talking about small cap stocks. I'm talking about large, reputable brand names, global companies. Gold has done tremendously well for what it's supposed to do. If you're an institution, it's supposed to hedge your equities portfolio, and it's done that marvelously. In fact, if you sell gold now, you've made 2% in 2022. You're one of the best hedge funds of the year, and then you can buy equities that are down tremendously, and that's exactly what it needs to do for short-term hedging. Compare that, obviously, to what other people have called digital gold and what HIT has done in 2022, so Bitcoin, and you see that gold is actually having a phenomenal year for what it's supposed to do. It is supposed to preserve your wealth and hedge. Now, if you're a long-term holder, then realize that when the Fed raises rates, it creates obviously an incentive for people to go in from cash to bonds. And when you do that, because of the income you can receive from the coupon payments or the interest payments, that lowers the demand for gold. So the higher interest rates go, the less of a demand for gold. So the real era for gold to shine would be just like in previous times. And it would be when the Fed basically does the opposite of what gold bugs expected to. When the Fed actually declares victory on inflation, or say that they've turned the corner on inflation and they can start easing again, that's when you'll see gold doing even better. Now, with CPI about 8.6% and the Fed funds rate at 1.5, we're definitely in a negative rates environment. So I don't see gold weakening. I see it strengthening throughout the year. But I think that the best times for gold will be in the second half of the year after September, when the Fed starts to claim that what they're doing is working around the midterms. And I also expect a lot of promises during the midterms, because what we have not seen in 22 at all is solutions. We've seen a war in Europe, no truce, no negotiations, no nothing, no progress. We've seen inflation, no progress. Recession fears, no progress. No one disputing information. We've seen a housing problem, no solutions. So we haven't seen any solution, anything to relieve anyone in the markets, and that's what I think is going to really help in the second half of the year with with midterms coming and a lot of this promises that are going to come from both sides, and I think also more action from both sides, especially from the administration. So to me, the second half is going to be way better than this one. This is accumulation for those who know what they're accumulating and that they're working on a long-term portfolio. And I'm actually very pleased with gold in 2022. I didn't expect it to go on an all-time high when everything else is crashing around it. What it's doing is perfect for what people's expectations should be of it. And I think in the second half it's going to do even better. And we might even see the 2000s again, either towards 2023 or in 2023 when the Fed raises rates. I think it will continue to do so, but at a far slower pace. And I just don't see CPI numbers coming down substantially to where we go to a positive rate environment, inflation adjusted. With regards to silver, I think the price is reacting to recession fears. Once recession fears subside, because in my opinion, we are already in the recession. The markets are just pricing that in, but the Fed obviously will not come on stage and admit that we're in a recession. But I like looking at real world economy stuff. I'm looking at parking lots for malls. I'm looking at traffic. We are in a recession. We are in a in a very sharp slowdown in the economy. And I think that we will actually start seeing us coming out of it in the early parts of 2023. And that's when I expect silver to do extremely well and go towards the 30s, as you mentioned, and even to the 35s. I actually put together these 11 catalysts for gold if you want to check them out and understand like exactly why I think gold is going to $2,582 an ounce during this cycle. And you can go to wealthresearchgroup.com/11, like 11, and download. It's a very quick, straight to the point report with a lot of data and great charts, historical charts that show you the trends that we're in.
I'll make it easy for everybody. I'll put those links in the description below this video to those reports, wealthresearchgroup.com/ I remember bear, and then /11, and there were a couple others. We'll put all those as well as the main page so people can sign up for the newsletter at Wealth Research Group. So my father taught me during times like this to look for undervalued companies, like for example Ford right now, PE ratio of around 4 for Ford. I mean, should I be looking for a low PE ratio or just low valuation multiple companies right now? Is that a viable approach?
I think what's happening right now is a contraction, right? So liquidity is being drained out, growth is not happening, so new debt to hire people and all these growth companies that hire thousands and thousands of people at good salaries. This is not happening. It's contracting. Startups and whatnot, venture capitalism is contracting. And that's why you're seeing this rush to value, this rush to judge every company by the present, by the bottom line, by what's happening right now. Any CEO that tells you, hey, we're going to grow, and in 5-6 years we'll start to think about profits. Nobody wants to hear that right now. Everyone wants efficiency right now. Lay off employees if you need to, cut the margins, cut the growth. I want to see that you can turn a profit on this business. That's what investors want right now. And that shift is to value, like you say, and to focus on PE ratios and traditional metrics of value and not of growth. So I do see that happening on a global basis as at the institutional Wall Street level. For us as individuals, I think we should focus on two things at all times. I call these things, one I call excessive returns, and the other one I call better than index companies. Let's start with the excessive returns. The excessive returns is when you understand the major trends and preferences of investors for a cycle, and you focus on the best companies for that cycle, and then as the cycle progresses and you're making excessive returns because you're focusing just on these companies that are loved, you take profits. And so that is more of the way I look at a trend. Now, I don't do these trends on a monthly basis. I do them on a multi-year basis. The best example I have of the previous cycle is Microsoft. Microsoft in 2011 I purchased shares at $27 and then continued to accumulate. And then I added Apple to that in about 2013. And for 7 or 8 years, those two companies were really favored by the market. They're still favored, but they were invincible for many years. And you have to take profits along the way when you see that the trend is kind of ending, when you see that they're becoming vulnerable. That's what I call excessive returns. So find the companies that you believe will now, for this cycle, have those excessive returns, that the markets will like to give them a premium, and you can continue to accumulate shares in them. And then when you think the cycle is starting to end, you can start to lower your position and transition some of the profits into other sectors, or just wait in cash for the cycle to turn. That's excessive returns. And I think what you're talking about, which are companies that have a better balance sheet, that are focused on profits. I think those will have the excessive returns in the years ahead, what we call value stocks. I can tell you a few of my favorite value stocks and just as examples. And then that's the second group, which is where I put more of my money, is what I call the better than index companies. And these are companies that are within the index, within the S&P 500 or within the NASDAQ, but I believe that those companies are superior to the aggregate index. Obviously, the index is comprised of S&P 500, 500 companies, the NASDAQ 100 companies. Within that index, there are better companies in general, not because they are currently favored, but because they are just superior businesses to the median. And if I can continue to build positions in them forever, for the remainder of my adult life, when they are selling at a discount, I love that idea, because in bull markets, they do better than the index, and in bear markets, they do less bad than the index. And if you can also purchase them after declines, then you will even do better than that. And the differences are huge. The S&P 500 returns about 8% if you just buy and hold all the time. But these companies, they return between 13 and 17% if you continue to buy more shares of them all the time on dips for decades. So these are phenomenal companies, and there are not a lot of them. You're talking about a select few companies that you need to focus on in this niche. And that's what I focus on. So for me, a year like this is a year where I can accumulate a lot of these companies that are better than index, because the index is falling and those companies are falling as well. And with excessive returns, I'm doing two things. One, the out of favor sector, the growth sector, has collapsed, but within it, there are phenomenal companies trading at a discount, and they are just grouped in that growth basket, but they have nothing to do with the speculative growth companies that led this sector. I can give you a great example. In the dot-com bubble, Amazon shares went from $100 a share to $6 a share, all while Amazon kept growing throughout those 2 years between 2000 and 2002. And if anyone wants to access the shareholder letter from Jeff Bezos in 2002, where he talks about this, he said, I don't know, I don't care about the stock price. The business is doing amazing. The stock price will follow whenever it follows, but our business is doing incredible. Those companies are out there today. Phenomenal growth companies that will be 10x, 15x, 20x, 100x, what they are right now. And they're just down a lot, at 50, 60, 70%. So that's in my excessive portfolio. I like those, but I also like, and I am buying companies that I've never owned before, because they're phenomenal value companies. So those are the three things that I'm focusing on myself. I do think this is a freak year because we are transitioning into this new economy. And so, yeah, I do believe that we are not in a V-shaped boom where this is going to, once we hit this bottom, whenever we hit that, we're going to go magically right up. We may not see the all-time highs for another 2 years here.
Got it. And for the last question, last few minutes, outside of stocks, how about crypto, real estate? Are there any, other than the stock market, any investments you're looking at now?
Yeah. If I was American, then I would definitely look at getting a line of credit on my real estate, because real estate has held up tremendously well. And you're not seeing the discounts in real estate. It's amazing to see how resilient the real estate market has been in America, despite the stock market, being so panicked about what's happening. Real estate is not. People are not selling their homes in panic. People are continue to buy homes. It's a very different environment than 2008. the credit scores, the people that own homes and paid off their monthly payments have great jobs. The last thing they want to do is foreclose on a house. They'll do anything to keep paying. So, in my opinion, the real estate market, whoever's looking for this huge bear market in housing, I think I don't think it's going to happen. We may be frozen for a while, for a year or two on prices, but I don't know if we're going to dramatically go down on a nationwide basis at all. So using leverage with your house, especially if it's an investment property and cash flowing, I think that's a wise idea. I would be selling real estate if I have a good investment. It wouldn't make sense to me. I would much rather use the equity, the line of credit that it can provide me with. So that's one thing. I do think we have a 3 million home shortage in America. There's so much more construction to do in affordable housing and in single family. There are big migration trends. You know that because in your area, I assume you're seeing an influx of new people coming to the Sunbelt states of Florida and Arizona and Texas and Nevada, coming from all other parts of the country. There are big opportunities in tax-friendly states and in business-friendly states. So in general, I'm not a buyer of real estate, and I'm not a seller of real estate right now. All of my real estate holdings, I'm keeping them safe for one, that I was partnered with another investor, and he wanted to sell it, and just because of that, we sold one property. But the majority, the other 95% of my real estate portfolio, I haven't sold, and I don't plan to sell, but I'm not buying either. So that's my feeling on real estate. I don't think it's attractive, but I don't think it's going to go down substantially and to make me want to sell any of my holdings. Because fundamentally, I think the real estate market has a lot more years of growth ahead of it. Millennials are getting married after 2 years that they haven't gotten married because of the health measures and restrictions. So 80 million millennials are going to tie the knot, build new houses. The demographics are incredible. Cryptocurrencies, correct? That was your next one?
Yep, a couple minutes on that.
Okay. Cryptocurrencies, I've never been a big bull or a big bear. Not something that I do a lot of thinking about. If I ever get into cryptocurrencies in a massive way, I believe it will either be indirectly, so ancillary industries like chip industries or whatever is needed for the equipment and the blockchain, etc., or companies that have blockchain solutions or crypto solutions or payments, stuff like that. And then in general, I think that the crypto market is going to go through a big storm of regulation in the next year. So that's happening. It's becoming more of a part of society. It's not going away at all. The younger people love it, and they're going to use it, keep using it, and the governments are now going to figure out how to get this more in line with us, and entrepreneurs are going to do it. So in general, it's going to become a bigger part of society. But for me, it's not something that is a big investment opportunity that I see specifically in owning directly the cryptocurrencies themselves.
Got it. Much appreciated. We've covered so much, and you give us always so much value on this channel. Mr. Lior Gantz from wealthresearchgroup.com. Go get the newsletter. And what are the links that people are going to see and people need to check out for the news, for these specific reports, I should say?
The ones I mentioned on the show.
There was /11 /bear.
/pain and /rug. These are download reports. And obviously, the best way to just keep following up and our research and what we do is to subscribe to the free letter. And if you want to see the companies that I'm specifically buying, that's the best way to do it. To do it through the newsletter. You can also go to our website. On the top menu, you'll see a tab called Watch List. You can click that and download a lot of the companies that over the years I've looked at and put on my watch list.
Awesome. Mr. Liorgans, thank you so much today. And we'll have to
Thank
do
you.
this again when your predictions come true as usual, and then we'll see what happens next. Thank you, sir.
Thank you, David.